Hey everyone, in this video I'm going to look at Synopsys, one of the leading semiconductor design companies, and answer whether or not I think the stock is a buy or if I think the stock is a hold or a sell. So I'm going to look at the company's revenue, its profitability, its cash flow, its valuation, and its prospects over the next couple of years to determine if I think this stock is a buy for long-term investors. So let's jump into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Synopsys stock price has risen considerably over recent years from a $150 per share stock price around 2020 up to a $558 share price as of this recording. But a share price increase on its own doesn't tell me enough if the stock is expensive or not. I need to know more information. I need to know what I'm getting. Yes, the stock price is higher, but if I'm getting more, I'll be happy to pay more, right? It's similar to when you go to the grocery store and you see a can of soda for maybe $1, but then you see a bottle of soda for $1.50. You might be willing to pay more because in the bottle of soda you're getting more than in the can of soda, right? So that's similar to what you see with stock prices. The price might be much higher, but you might be getting a lot more for your money. The key is to look into the company, look at the financial results, and see if you're actually getting more or if it's just a higher price for the same performance. Let's take a look at that performance. So revenue has definitely risen considerably over the years, and 5.843 billion to be precise over the trailing 12-month period. That's up from around 3.5 billion in 2020 and from less than 2 billion in 2015. Let's take a look at the total addressable market for artificial intelligence. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. So, given that massive market opportunity and Synopsys trying to penetrate that market, gaining traction in that market, and the recent acquisition aimed at developing that market opportunity, I think Synopsys has several years of double-digit revenue growth ahead. In fact, a little bit later in the video, we're going to look at what Wall Street expects from Synopsys, and it's definitely greater than double-digit revenue growth expected. The next thing to consider with Synopsys is its demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. All right, so now that we've had a closer look at economies and scale, you can see Synopsys operating profit margin 23.04%. That's up nearly double from the roughly 12% in 2015. Certainly benefiting from economies and scale is Synopsys, although there remains a question mark with the big acquisition. If it does go through, how that's going to impact the company's margin. All companies say that when they make an acquisition, it's going to benefit their margins. All companies say that, but not every company actually experiences those benefits from the acquisition. It's difficult to digest a company of this size, a multi-billion-dollar acquisition, and so this is going to be no different. It's going to remain to be seen how this is going to impact the company, and it should make matters only worse that Synopsys is going to borrow billions of dollars to make this acquisition. Those billions of dollars in debt is going to lead to increased interest expense, which is going to impact the bottom line. It's not going to impact the operating profit margin because interest expense comes below operating profitability, but it is going to impact the company's net profit margin, which is the bottom line here. So that's something I'm going to be looking out for Synopsys as it moves forward with this acquisition. Remember, it's not for certain it will be digested. Another thing I consider is the cash flow from operations to sales. Synopsys generating 29.15% in cash flow from operations to sales. This metric measures how much of a company's sales it turns into cash flow from operations. So for Synopsys, $100 in sales is turning into $29 in cash flow from operations. That's a good conversion rate. That's a meaningful amount of sales that's turning into cash flow. I like to see this. I don't like to see companies go after sales growth that are empty calories. Sales growth that turn into zero or negative cash flow. Some companies, you might be surprised, and if you've been following my channel, you've seen a lot of companies like that. Growing revenue, but then losing money and worsening cash flow. So they're spending cash to go after this sales growth that's hurting the company overall, with the hopes that at some point in the future, they might turn things around, they might improve performance. Those are really speculative investments. That's not the case with Synopsys, generating strong cash flow from operations, strong profitability, and demonstrating this over several years. So not just a one-off thing where they did it for 1 year, but they haven't demonstrated they can do this over a longer time frame. And Wall Street expects continued solid performance for Synopsys. Here I have their revenue and earnings per share forecasts. For 2024, analysts on Wall Street expect 13% revenue growth and 20% earnings per share growth. For 2025, Wall Street expects again 13% revenue growth, but a slowdown to 16.4% earnings per share growth. And in fiscal year 2026, Wall Street expects 13.6% revenue growth and 20.4% earnings per share growth. So solid growth, to be sure, expected for Synopsys over the next 3-year time frame. Finally, I wanted to look at its valuation because the best company in the world could be a bad investment if the stock price is too expensive. Synopsys is trading at a forward price to earnings of 36. If you go back all the way to 2021, this is near the most expensive this stock has been. Very briefly, it was more expensive in late 2021, and in moments in 2023, it's been more expensive. Synopsys on the more expensive side of its historical previous 3-year valuation. On the flip side, the company has excellent prospects over the next 3 years. It has demonstrated economies in scale, growing its operating profitability, solid cash flow from operations. All that considered, incorporating it with the valuation, I would say Synopsys stock is right on the borderline, on the side of being a buy versus being a hold, but right on the borderline because the excellent prospects come up against the expensive valuation to barely make it a buy for me in this case. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.